Today is Monday, September 7th, and this is a post-market review for the stock market activities on Friday and an outlook for this upcoming week. We will do things differently this time around. We will dip right into the charts analysis because we have a lot to discuss charts-wise. We obviously had major market moves, specifically in the NASDAQ, with a big drop on Thursday and another one on Friday. However, we closed well off the lows. So the question is this it? And there are two parts of this it question. Is this it, meaning is this as far as the correction would go? And is this it, meaning the crash? Is this the beginning of it, the big crash, the big correction that will fix the overvaluation problem in the stock market, and it that will burst the bubble that we're currently experiencing in different sectors of the market? I will answer both, but let's start by answering the latter. Is this it, meaning is it the beginning of the crash? Somebody asked me a similar question on YouTube a few days ago, and here is my answer. I said that I'm expecting a 10% correction in the NASDAQ to touch the April trend line. That is my first goal and expectation. And that leads us to the first part of the question. Is this it for the correction for now? We dropped 10%. Are we going to bounce back and rally and continue to trend higher? Or was this the beginning of the big correction and we might see a dead cat bounce and then continue thereafter to the downside? To answer this question, we need to look at historical examples of how trends end. We have a lot of examples looking back at the NASDAQ chart of strong bullish trends that morphed into very speculative and impulsive rallies during the last part of the trend, which led to those trends being broken, corrected, making way for new market trends to emerge, positive and negative. In this video, we will take a look at two historical examples, one during the dot-com bubble in 1999 and 2000, and the other one during the first quarter of this year. We will look at these two trends, how they behave, how they ended, and we will compare them with the trend we have today to learn how to identify when and how the current trend will end. We will start by looking at the trend from 1999-2000 during the dot-com era. Now, the dot-com bubble era started in October 1998. However, what I'm interested in is the mania part of the dot-com bubble, which started October of 1999, because it's very similar to the trend we have today. And as you can see from this trend, it had major corrections along the way, anywhere from 6 to 15%. And you see the big reversal red candles along the way. Each one of those, the bears and the shorts who thought that this market is ridiculous and overvalued and is due for a big correction, a big crash, were proven to be absolute fools. And what they did by shorting the market prematurely is they added more fuel to the rally as they were forced to short cover. It was extremely frustrating for the bears and for any rational market participant back then. How could this rally continue to go up and up every day? And every correction that we think is it, quote unquote, turns out to be another stop to refuel and ignite the rally higher. And as you can see from the chart, we had at least 4 of those incidents where shorts and bears thought it was quote-unquote it, and they got their asses handed to them. And then by the 5th time, a similar, almost identical look happened in the market. The bears and the shorts were starting to give up, and they thought, oh, this is just going to be another one. They're trying to fool us again. They're going to reverse and reignite the rally again. So this time around, we're not going to be fooled. We're actually going to buy stocks and we're going to join the rally. And what do you know? That one, the 4th one, was quote unquote it that broke the trend. So why was that particular correction it? Let's switch to another look of the same trend. We had three pierces of the trend line. One in the beginning of February, another one in March, and then the last one that killed the trend in April. And the question begs itself. How do you know whether this is going to be just a pierce below the trend line and a reversal and a continuation of the rally, and between a pierce that leads to the end of the trend and the cascade to the southern destination? To answer this question, we need to switch to a weekly view of the same trend line. Here is the weekly view, and you can see the three same pierces on the chart. The last one is not showing quite well, but you can see that little dot, yellow dot on the red candle. That is the same pierce that you just saw earlier. Now we look at the parallel points of those pierces in the weekly MACD indicator for the NDX, the Nasdaq. And we're looking, of course, at the NDX chart, not the triple Q, because the NDX is older than the Qs and has more data. As you can see, the first pierce, the MACD actually did pierce the average blue line and did make a red impression on the indicator. That was the biggest tease. Everybody thought it was it, and it turns out that it's not it, and we continued to rally. And you see in the second incident, yes, we did pierce below the trend line, but we did not pierce below the average, and we did not make red impressions in the weekly MACD indicator. So that was another false alarm if you were paying attention. Now, the third one that actually did break the market looks very different. If you look at the MACD from a weekly perspective, it did indeed pierce below the blue line, the average, significantly, and it started making strong red impressions. If you were paying attention to the weekly MACD, you knew that this was quote-unquote it. So keep that perspective in mind. And now let's switch to the Nasdaq chart of the first quarter of 2020. The trend actually started from October 2019 and continued all the way till late February of this year. And we are all aware what happened with the COVID correction. And as you can see, this trend line had corrections along the way, very small corrections, anywhere from 1.5 to 4%. And at the later part of the trend, or the last part of the trend, you can see the impulsive rally, the divergence from the trend. When you diverge and extend significantly from a trend line compared to its previous historic corrections, that is pretty much a good sign and a signal that we are nearing the end. And as you can see, the last correction was over 9% and it did pierce below the trend line. And it was the breakage and the end of the trend. Looking at it from another perspective, let's look at the pierces or near pierces of the trend before. We have a 1, you can see it, and we have 2 and 3 circled in those 3 yellow circles. Let's see how they look from a weekly MACD perspective. And here you go, I drew vertical lines, one for the first circle and one representing the 2 last circles that almost pierced the trend line. Because they were so close together, they show as one circle in the weekly MACD. And as you can see, in both or all 3 incidents of pierces or near pierces, we did not pierce below the average in the MACD. We never crossed the blue line and we never created red impressions in its histogram. And if you were paying attention back then, these circles represented a dip worth buying to join the rally higher. Now, let's switch to the current trend that we have in the Nasdaq. You see it right in front of you. It is a perfect trend that started around April of this year, and it is continuing to this current date. As of lately, however, specifically the later part of August, we have rallied impulsively and diverged from the trend line significantly. That was a sign right away. If you've been following me, I told you that we've diverged higher than we've ever diverged before in this trend. That is a sign and a signal for a correction. And what we did, of course, is we bought calls on the short triple Q and we shorted the Nasdaq and we made significant profits last week. Now, as the correction reached the trend line and caught support from the trend line, I was tweeting on Friday about the support indicating that the support is holding, and I'm closing my short triple Q calls and my T triple Q puts, getting rid of all of my options positions against the Nasdaq because the trend line held support strongly. I wanted to close just half, but I ended up closing all of my options positions, and I did close a portion of my short triple Q holding because I own options and I own the inverse index itself. That doesn't mean that my stance changed just because we caught support from the line. Make no mistake, the moves that we've seen the last few weeks are very indicative of the death of a trend. Historically speaking, every trend acted and reacted the same. During the last period of its age, you see the impulsive rallies and the divergences from the trend line, followed by severe corrections back to the trend line, and in other instances, piercing below the trend line, and of course, finally crashing and ending the trend once and for all. As you can see, we have witnessed major corrections throughout this trend. It doesn't seem like it, but we did. Anywhere from 5 to 10%. And of course, you see the last correction was over 10%, and the reason is we diverged higher than the average divergence from the trend line that we've seen before. I've been saying the higher the divergence, the steeper the correction. Now, this happens to be a very clean trend with no pierces so far, exception of course during Friday. From a 1 minute perspective, as you can see, we pierced slightly for a very short and insignificant amount of time. That happened around 7:45, and you can see that my tweets saying that I'm closing my option positions against the Nasdaq or my bearish positions for the Nasdaq shortly after the rebound and the reversal from the piercing of the trend line. And here is the $1 million question. Where are we now from a weekly MACD perspective in this current trend? When we look at it, we are not even close to piercing the blue line, the average, and making red impressions. So what do you do with this kind of information? For now, as far as I'm aware, the chart acted exactly as I expected. It corrected 10%, it touched the trend line, and it is bouncing from it. So does this mean that we should all hop in and buy calls on the Qs right now? Absolutely not. But it also means that you should have or should be closing your put positions in the Qs or your call positions in the short triple Q or any inverse index, because the goal has been reached and now we have to wait and see. Make no mistake that the behavior that we've seen from the charts as of late is very indicative to the end of the trend. However, you have to be cautious and disciplined not to jump the gun too early and short and find yourself along with other shorts being forced to cover and fueling the rebound and the rally higher again. The market has a funny way when conducting market Darwinism. It will make sure to shake out the weakest hands in the most violent way possible and the most volatile way possible before making the move it intended to do all along. Meaning, a lot of shorts hopped on the ride, shorting the Qs. And perhaps we will wake up tomorrow and the Qs will rally and these shorts will scramble and they will cover and they will fuel a rally to the upside. Now the shorts are getting a nice smack in the mouth and they're losing quite a bit of money. And what happens on the other side of the aisle is the longs and the Robinhood gamblers and the rest of them feel safe that this was a mere correction, just like the ones before, no different whatsoever, and it was just an opportunity to buy, and they will pile in buying calls and buying stocks, thinking that the smoke is clear. And what do you know? Now that the market shook out the weakest shorts, now it shakes out the weakest longs and it flushes the market down, taking all these dumb longs who joined the rally out, and now they get a nice smack in the mouth and they lose quite a bit of money. And at the end of the day, the market did what it wanted or what it intended to do all along, ending the trend, ending the impulsive uptrend, but it's not going to do it so easily. It has to create some volatility to shake out the weak hands and create as much financial damage possible to all market participants. Then it would do what it always wanted to do. So you, as a smart investor, as a smart trader who watch this channel, you know that you will not jump the gun and short this market again in an aggressive manner until you see the decisive breakage of the trend and the decisive pierce in the weekly MACD, crossing the blue line, the average, crossing the histogram and making red impressions. This is the discipline. Either you're a discipline or you're looking for a quick buck. And what you're going to do is you're going to hop in this week and next week buying calls or puts, expecting big moves, and you're going to get it wrong and you're going to lose a lot of money. Stay disciplined. We had indicators of the reversal. We played it. We made money. Now we wait and watch what other signal the market will give us. And by the way, your MACD and your program might look different. So here are the settings that I've been using since I was a toddler, and it never failed me at all. You can copy these settings and have the same look of the MACD that I have. But heed this warning. Please don't go to any individual stock chart now. Switch to the weekly view. Look at the MACD and say, oh, the stock is about to crash or about to rally. There are the do and don'ts in using the MACD. That would be a subject for a different video that we can discuss later. But for now, the weekly MACD, as I am showing you, has over 20 years of historical accuracy when it comes to the chart of the NDX. That is the one we are watching. And now we have to switch and measure the psyche of the market and its participants, because we can't just look at the charts and make independent decisions based on the charts alone. We have to gather as much information as we can from the news, from the charts, from the psychology of market participants, from volume trends, from the options market, from the futures market. This is why in this channel we cover a wholesome approach of different subjects, gathering as much information as we can to make rational and educated decisions in our investing strategy. When the market opens on Tuesday, we'll be past Labor Day and the summer solstice, and now we're going back to business, meaning the professional traders, professional firms will become more active this week, but specifically next week. And we could see an alliance here between bears who are waiting and been waiting for a market crash and a correction in a meaningful way, and professional traders who will look at their portfolios and see the exuberance and perhaps start trimming, if not unloading, entire positions. On the other side of the aisle, you have the Robin Hoodiots and their new ally, as we discovered last week, their sugar daddy, the king of all Robin Hoodiots in the world, Masayoshi Son, aka the devil. We will look at the interest and the psychology of each of these players and how they can shape the market. The psychology of the bears is that they've been looking for revenge for a long time. They tried to short this market multiple times throughout the rally, and they only made a fool of themselves. They got their rear ends handed back to them, losing significant amount of money, even though the market is irrational and makes absolutely no sense. But the market can stay irrational longer than you can stay solvent. And now the bears are looking for revenge, yet they're very traumatized from past experiences in this trend, meaning that there are two sides of the bears. One, those are the dummy bears. They saw the movement last week, and now they're excited, thinking that this move is quote-unquote it. They will go all in, shorting the market. They will get caught in the trap, and all they'll do is fuel another market rally due to short covering. The other side of bears, who are still traumatized, what they will do is shorting, making a bit of profits, and closing those profits prematurely and very fast because they're traumatized. Every time they short, they make a little bit of profits, the market reverse, and they lose it all. So now they made a little bit of gain, they take it off the table, and they go. And what do you know? The market continues to slide lower and lower because when finally the market is going their way, they're still too afraid and traumatized to have the confidence that this is quote unquote it. There are two sides of the story. And now after I explained to you how the charts work, you know when quote unquote it will happen. So you are neither of these dummy bears. You are the smart bear and the smart market participant. And by the way, you cannot be a smart bull after all this rally. Anybody who wants to buy the market, specifically tech, you're not a bull, you are a donkey. The only rational way in this market is to be bearish right now. Now, we do have professionals who've been dormant and hibernating throughout the summer. That is their typical behavior. Even though we are in very different times and there is no summer travel, etc., etc., but usually trading from professional firms dries out during the summer. It comes back after Labor Day, and it comes back aggressively, specifically during election years. Now, there could be a lot of betrayals here between these two sides. Don't assume that they're allies together. They just have mutual interests, but they could betray each other and stab each other's in the back. The professionals might not dump as the bears expect them to, and the devil, of course, might abandon his calls, positions, get out of the market, crashing it on the heads of the Robin Hoodies. So keep that in mind. But what is the psyche of professionals right now? They've seen and they know that the tech gains are irrational. They went really, really high, but the momentum is really strong. So what they're doing, of course, is trimming their positions. They're not going to get out of these positions completely until they start losing money or losing significant amount of their gains. This is typical behavior, by the way, from professional money managers. And the other excuse they use, of course, for staying in the market significantly is TINA, the fear, or not the fear, there is no alternative. That is TINA. The fear of missing out, that's a different thing. TINA is there is no alternative because bond yields are really low. Interest rates are will continue to be suppressed rather by the Fed. And these professionals are saying, hey, there is no alternative. You gotta keep your money in the stock market. Tina, remember when Tina broke your heart in high school? She's gonna do it again because this is the dumbest way of thinking, that you are not gonna book your profits because of Tina. How stupid are you? The other excuse they use, of course, and I never understood that one, is because they don't want to pay taxes. You're gonna pay taxes sooner or later. You better pay them now before the Democrats take over and raise their taxes next year. So I don't understand why they would hold into positions to avoid paying taxes. You will pay them sooner or later. You might want to take the gains and pay your taxes because that would net you more profits than waiting, losing your gains, and then paying your taxes anyways. But this is how the zombie professional traders in big financial firms think. I remember back in 2018, during the amazing run of January and February 2018, the market made, again, an impulsive trend. It got out of whack, and it was pretty much trading in a vertical line. And what I thought is, hey, I got to take some profits here for my clients. I got to book profits, get the hell out of the market because I know what will happen next. So in late January, I took everything off the table and I got a lot of heat from clients calling me and saying, why did you take positions off the table? We're going to miss on all these gains. The market is rallying. There are no taxes anymore. And I looked like a schmuck for a few weeks. And when talking with other managers, why don't you guys trim a little off your positions? The market is irrational. It's going in a vertical line, literally. They would say, there is no alternative. Tina, you can't move it to bonds. You gotta wait. You gotta keep your positions. Things are improving economically. Taxes are lower, stocks are going to continue to go higher and higher, the Fed is on our side. What do you know, a few weeks later, the market crashed in one of the most epic, biggest crashes in history. And now my clients are calling me thanking me for getting them right when I did. Meanwhile, for the other zombie professional quote-unquote traders, their clients are now calling them saying, hey, we used to have 30% gains, now we're down to 12. What happened here? And they'll tell them, oh, it's the stock market. It goes up and it goes down. That is how market cycles work. You gotta stay in it for the long term. All that bullshit. Meanwhile, you knew that you should have booked your profits when the trend becomes so impulsive and it's ready to pop. That is the lesson of the day here. Now, looking at the other side, the dark side, the Robin Hoodiots and the devil himself. What are they thinking? The Robin Hoodiots, of course, are zombie traders programmed on autopilot to buy stocks and buy calls. That's all they know. They know that stocks go up all the time. There are no red days. And if there are red days, there are opportunity to buy cheaper. So they have the recency bias. They will revert back to what's been working for them. Buying weekly calls, buying stocks again. They will do what they do until they lose all their money. Meanwhile, the devil is motivated by greed and fear. He's of course in a lot of trouble, and we'll talk about this son of a bitch in a different video because it's a longer topic, but he's been in a lot of trouble lately. He's a gambler who turned professional investors because he is a very charming con artist. But he is in big trouble this year, and he decided that now is the time to get himself out of the hole because his investors are calling him and they're angry. What the hell happened to our money? What's going on? You're investing in WeWork. That didn't work. You're investing in companies at their highest valuations. You're entering the market. Your timing really sucks. You're investing in speculative startups. You invested in Bitcoin and you lost. So the devil figured out that he can do a cute move of overwhelming the options market and buying billions and billions of dollars of call options, making a quick profit, significant profit in a short amount of time, and that should calm down his investors a little bit. That is starting to fire back, and you saw that SoftBank shares today down significantly because investors are now figuring out this con man is just a gambler who has no clue what he's doing. He only had one lucky streak with Alibaba. And that is it. So this is the most dangerous player in the market right now because he could pull the rug really fast. He bought these calls options, and I'm assuming that they were bought in and around August 26. Because if you remember, August 26, and here is of course the rotation scoreboard from that specific day. Tech stocks rallied impulsively. I mean, you see Netflix rallying double digits based on nothing, Amazon, and we were all wondering what's going on. It can't be just the Robin Hoodiots making these very large moves in the options market. I understand that they can buy 1 million or 2 million of Apple options, but they can't buy Tesla or Amazon options to this significant magnitude. They're expensive, and now we know that the devil was behind it. So now, as he's starting to lose some money from his calls, you saw the flush down on Thursday, and on Friday, option riders, the banks who wrote him, those call options are gonna start to dump shares because they don't need them anymore. Some options get closed before they exercised, leaving option riders with excess amount of stocks that they used as a hedge when they wrote the call option. They have no need of holding the stocks for a prolonged period of time. They can ride it for a little bit, making profits, but they will dump sooner or later. And he is, of course, going to panic, specifically after today's move in SoftBank shares, and expect him to close and dump all of his call options, and he will end up betraying the Robin Hoodiots. He was helping them throughout the summer. Now he's going to stab them in the back. And the last thing I want to touch in is the Fed. How is the Fed factors in with all these players? Jerome Powell, the Fed chairman, had a very long interview with NPR on Friday. In it, he described what's going on in the stock market as excessive exuberance, meaning that even the Fed knows that this rally is unsustainable. That is your signal to be extremely, extremely careful. Don't trade this market thinking that you are a psychic and you know what's going to happen next. You don't. If you trade as a psychic, you will lose money. Trade with the facts. I showed you the facts that you need to look at to confirm market moves. Follow them and you will make money. There are times when you don't need to trade. You just need to sit out and watch the show. And this is what we're going to do the first few days of this week until we get more information for the next move. Now, the last thing I want to show you is the MACD, the weekly MACD for the big four horsemen of the technology sector. And of course, these four names are the ones driving the options market, whether coming from the Robin Hood idiots or from the devil himself. It doesn't matter. Apple, Facebook, Tesla, and Amazon. As you can see, the weekly MACD in Apple were still extended. We're not even close at crossing and making red impressions at all. The same picture is in Facebook. We see the same thing in Tesla. We're not even close. However, when you switch to Amazon, whoops, we're getting very close here. So watch Amazon. If Amazon starts to break, crossing the blue line in the weekly MACD, making red impressions, that would be your leading indicator that the rest of them will follow Amazon. And if you do, by the way, the same exercise with some momentum stocks like PayPal and Square and Wayfair, you will see that they've already crossed the blue line in their weekly MACD and they are making negative impressions. Now, which chart is doing the opposite, crossing the blue line in the weekly MACD to the positive territory and making green impressions? The VIX. Do you need any more signs and signals that the trend of this market is nearing the end and the death of the trend is very, very imminent? If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.